Hello everyone. In this session, we'll keep working with the income statement and we will move from the purpose and limitation. This is what we covered in the prior session, to the elements. What goes on the income statement itself? Which accounts? I'm going to list them right now. Revenues, expenses, gains and losses. We need to define each one of those and we need to see how are they listed on the income statement itself. So you want to be familiar with the elements of the income statement. Also in this session, I will show you the two format of the income statement. Income statement could be a single step, could be a multiple step. You need to be familiar with both, just to kind of be familiar whether you are an accounting student, a CPA candidate, CMA candidate. You want to know these elements inside out. Those are basic information, critical pieces for your success as an accounting student, as a CPA candidate, as a CMA candidate. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. So let's start by looking at the elements and content of the income statement. I'm going to list the elements here first. I'm going to go through each one of them separately, explain each element, and I'm going to show you how does it fit in a typical income statement. First thing, I'm going to look at a multi-step income statement, and I will show you a single step because I also want to show you, as I mentioned, the income statement format. Starting with the headings of the income statement. Each income statement will have a heading, and the heading would include the name of the company, the name of the statement, and the date. The date on the income statement is for a period of time. Period of time means it covers a period of time for year ended. It's not for one particular date. It's for the whole year, December 31st, 20x4. And this is important. Why? Because it's covering a period. When we look at the balance sheet, a balance sheet is a point in time. An income statement would always start with revenues. So we need to define what are revenues. Revenues increase in assets or a reduction in liability as a result of delivering or producing goods and services from the company's ongoing central or major operation. So that's the definition of a revenue. Well, if you want to really simplify it, what are revenues? Revenues is what the company would do on a day-to-day basis to increase their asset and reduce their liabilities. What could be some examples? Well, most companies they sell something. Well, if they do sell something, goods, it's sales revenue. Consulting companies, they provide consulting work. They have consulting revenue. Universities, they provide tuition revenues. For example, Farhat Lectures, my revenue is your subscription revenue. So this is the revenue. Now, for example, a company like McDonald's, what's their revenue? Usually it's the burgers, the fries, the meals, that's their revenue. So the first thing on the income statement is we list the revenues. Then after the revenues comes the expenses. So what are the expenses? Can you think of them as the opposite of revenues? I would not think of them as the opposite. I would think they are necessary to generate revenue. What are these? What's the definition? It's decrease in assets. So somehow our assets are going down. Or increase in liabilities. We are incurring more liabilities. Why? As a result of incurring cost. To run the business, we have to incur cost. For example, if we go back to the McDonald's example, what do we need for McDonald's? We need to have delivery trucks to deliver the product. We need to have employees. We need to buy the fries. We need to buy the buns. We need to buy all sorts of goods. We need to pay rent. We need to pay taxes. We're going to have a depreciation on this truck. So you have a cost to run the business. The cost to run the business on a day-to-day operation is called an expense. Example of it, cost of goods sold, rent, depreciation, salaries, delivery expense, a whole bunch of them, operating expenses. So that's another section of the income statement, expenses. Then we have a section called gains. Gains sounds good, right? Gains are increase in asset or a reduction in liabilities. Hold on a second. I just saw that statement. It's right here. Increase in asset or a reduction in liabilities. Notice where it differ. It differ when we say as a result of peripheral or incidental transaction versus as a result of delivering or producing goods and services from the ongoing central operation. So the gains and the losses are increase in assets. Yes, they are good stuff, but they are the result of what? The result of selling an item. For example, going back to McDonald's, if you saw that truck earlier, let's assume this truck here. McDonald's at some point might sell this truck, and let's assume they bought it for the sake of illustration for 100K. Then let's assume they can sell it for 120. That's not usually the case, but I'm just trying to make the point. Why? Because if you use the truck, as time goes by, you're not going to sell it for more than when you bought it for, usually, right? But just go along with my example. Now this is a gain because McDonald's is not in the business of selling delivery truck. They're in the business of selling food, beverages. Therefore, this is considered a gain. Although they increased their asset by 20,000, it's a gain, not a revenue. Sale of investment, if they have an investment and they sell it, for example, McDonald's can invest in Apple computers, they can invest in AT&T, they can invest in other companies and make a gain on those investments. That has nothing to do with their business. Well, let's talk about losses. Losses are decreases in asset or increases in liabilities. Again, if we look so far at this definition, it looks like the definition of expenses. Decreases in asset, we're using up asset. And what do you usually, when we say decreases in asset, which asset do you decrease to run the business? You guessed it, you use cash, right? But I want you to, let me just change it to yellow. I want you to see first that it's the same beginning definition of an expense, but from peripheral or incidental transaction. Going back to that truck, to that delivery truck. Now let's assume on the other side, remember we said McDonald's bought that truck, that delivery truck for 100,000, and I told you most likely they will not sell it for 120. Most likely eventually after they use it, they might sell it for 40,000. When they sell it for 40,000, they would have a loss. Well, that loss is a loss. It's a reduction in their asset, but not as a result of running the business, as a result of just simply what we called a peripheral, something that's incidental to the business. They don't do this on a regular basis. They don't buy and sell trucks. That's not their business. Therefore, we cannot call it an expense. We can call it a loss. So losses will be generated from the sale of property, plant, and equipment, sale of investment, other things, but those are the main things. So let's take a look at the income statement, the multiple step. As I mentioned, first you have your revenues, sales revenues, then you deduct your cost of goods sold. Those two will give you gross profit. So this is one section of the income statement, the gross profit. Sometimes revenues, you have revenues minus returns minus discounts to get to net revenues. You could also break this down further. Then we list our operating expenses, expenses to operate the business, and we're going to break them between selling and administrative. What are selling expenses? Selling expenses are expenses that we incur to sell the goods, like sales commission, like depreciation of sales equipment, like delivery expense, like advertising expense. Those are expenses we incur to do what? To help us sell the goods. Well, if that's the case, they are called selling expenses. We add them up, and they are up to $17,150 for our purposes. Then we have administrative expenses. Administrative expenses are expenses that benefit the business overall. They don't only benefit sales, they benefit the overall operation, like officer salaries, depreciation of office furniture and equipment. You know, we might have a headquarters where we have our CEO, CFOs, HR department, accounting department, all the support groups to sales. They would have office furniture. They will depreciate this. Well, that's an administrative. Notice depreciation could be operating expense, could be also administrative expense, depending on what you are depreciating. So operating expenses could be broken down by selling and administrative. Then we add up all the expenses. They add up to $26,010. Now, gross profit minus operating expenses will give us income from operation, and this is an important figure. So if you're evaluating a company, if you are judging the performance of a company, you would look at their income from operating the business, because that's why would you invest in a company? Because they are operating and making a profit from what they do. Then after that, we have
other revenues and gains. Notice we talked about revenues and gains. This is where you would list revenues and gains. So far what we looked at is revenues minus expenses, and this is the most important. We could have other revenues and gains that are not central to the business. Like what? We could have a gain on a sale of a warehouse. We sold a warehouse, we have a gain of 10,000. We could have rented something. We rented something to someone else at 17,230. We have other revenues of 45,920. We could have other expenses and losses, expenses that has nothing to do with our central ongoing operation. Like what? A good example will be interest expense. Interest expense is the cost of doing business. The cost of doing business has nothing to do with your operating expenses. It's the cost of financing yourself. It's listed under other expenses. Also, if you sold an investment and you incur a loss of the sale of the investment. Then we will take our operating income plus the revenues and the gains minus the other expenses and losses to come up to income before income tax. And this is usually called earnings before taxes, or EBT. We list taxes separately. Taxes is not an operating expense. Taxes is not a financing expense. Taxes is a government expense. The government wants share of our profit. Okay, that's fine. We're going to list this separately because it has nothing to do with our operation, how well we are doing or not doing. It has to do with which jurisdiction we are subject to when it comes to taxes. We pay our taxes. Then after we deduct the taxes from income before taxes, we get to net income. Then from net income, we take our net income divided by the number of shares outstanding, and we'll get to something called earnings per share. We'll have a lot to talk about that in a separate recording. But this is a multi-step income statement, breaking the income statement into multiple steps. Gross profit first, selling to administrative 3. I'm just breaking it down to show it's a multiple step. Other revenues 4, other expenses and losses 5. Taxes 6. I mean, it doesn't have to be this. You don't have to break it this way. You can break it revenue 1, expenses 2, other revenues and gain, and other expenses and losses 3. It's just all what I'm trying to show you is it's a multiple step. Now, why am I showing you this? I keep saying multiple step because we could have a multiple step income statement, and we could also have a single step. What's a single step? Well, you list all the revenues together and gains, net sales, gains, and rental. We list them all together. Then we list all the expenses together, cost of sales, selling, loss, administrative, interest, all the expenses together. We just keep tax separately. Then we get to EBIT, earnings before taxes. Then we deduct the taxes. Then we come up to net income. Net income is the same for both companies. It doesn't really matter. But the point is, it's the same, but the income statement is more summarized. Now, obviously, as a business, as a user, you would prefer a multiple step to give you a little bit more information about the company. And usually if the company do provide a single step, they do provide you schedule for selling expenses. They would list them, schedule for administrative losses, information about their loss, information about their gain. So they do provide additional information, but the format could be a single step or a multiple step. What should you do now? You want to go to Farhat Lectures, look at multiple choice questions, additional lectures about the income statement, help you with your CPA exam. In the next session, we would look at other items on the income statement that you don't see here. We're going to call them unusual and infrequent, and it means they don't happen often, but we'd have to look at them separately, and other items that go on the income statement. I would say this is a clean income statement. It's going to be more complicated. We're going to look at unusual items. The word by itself is unusual. We're going to look later on at discontinued operation. We're going to have a full picture of the income statement. That's the whole purpose of these sessions. Invest in yourself. Stay motivated. Good luck, and of course, stay safe.